Is the bear market already over? We'll talk about that today on 3 Minutes on Markets and Money. Over the last couple of weeks, we've talked about how negative sentiment was, how negative positioning was on markets, and very likely we were going to have a reflexive rally in the markets because of all that very negative sentiment. Negative sentiment tends to be bullish for stocks. I know that seems a little backwards, but when everybody's bearish, typically markets do exactly the opposite of what you think they should do. And lately, everybody has been convinced the world is going to end. We're at World War III. We're going to have a food famine, food shortage, and we need to all be in ammo and beanie weenies and bunkers, right? And that type of very negative environment is actually bullish for stocks. And this is exactly what's happened here over the last couple of weeks. Let's go through the technical setup of the market as we see it right now. First of all, we've had several retests of lows in this markets here over the last couple of weeks. Starting in January, we had this very sharp correction and intraday reversal of the markets, and that was kind of that first sign of that test of the lows. The markets then rallied back to the 50-day moving average here before declining once again, and then here in February was where Russia actually invaded Ukraine. That was the day the Nasdaq actually opened down about 3% and then rallied back up to nearly 4% by the end of the day. A huge intraday reversal on the markets. And that, again, that retested that low previous from January, rallied back up to resistance, failed, and then retested again here just recently back to those lows. So again, we've had multiple retests, a building of this bottom in the markets now over the last couple of months. Now this rally, because of this negative sentiment, has now broken above the 50 and the 200-day moving average yesterday. Importantly, we need to hold on to the break above that resistance. So over the next couple of days, the market needs to continue to hold above this kind of resistance level here in the markets, confirm that as now new support, and the market can then make an advance up to the top of the Bollinger Bands here, 2 standard deviations above the 50-day moving average as a potential top here. Now this would be about 4,600 on the S&P. And again, it kind of seems contrary to what you would think, given the Fed is hiking interest rates, that there's still war going on in the Ukraine, etc. All these very negative environments have already been kind of priced into the markets near term. And again, with such negative sentiment, not surprising to see a lot of short covering here, really pushing stocks higher over the course of the last week or so. That could very well continue into the next week. Now, look, we're not out of the woods by any stretch of the imagination. After this rally, we're going to have more consolidation work to do. We're going to have more risk going on. As we get further out into this year, rising interest rates, slowing economic growth, impacts on markets, earnings growth slowing down, etc., is going to certainly provide overhead pressure on prices, keeping prices suppressed. Again, another retest of these bottoms or potentially setting new lows later this year would not be surprising at all. But in the near term, there is certainly a bullish bias kind of being built into the market short term from a trading perspective. Markets are currently very overbought. So there is not a lot of upside to markets here. So a correction that works off this overbought condition without violating any major supports would be a bullish setup to add money to markets. But again, be a little cautious here. We've had a nice rally. Use this rally to reduce risk, rebalance portfolios. Things that have not been performing on this rally, probably a good idea to let those things go because they'll participate more on the downside when you have a correction. Things that have been working, look to add to those positions. Be careful about chasing commodity stocks, energy stocks, etc. Those are very extended, very overbought, and those are going to be impacted by demand destruction from higher interest rates and inflationary pressures as we get further into the year. So again, be careful where you're allocating money, but think about using this rally again to rebalance risk, raise a little bit of cash. Think about bonds, as we discussed yesterday on 3 Minutes of Markets and Money. We have an article out on Friday, why bonds may be entering one of the best bond buying opportunities in the last decade. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you tomorrow.